Welcome back to the Tomachek Financial Team weekly podcast. Once again, for a second week in a row, we've got Brad Volkins, who's a mortgage agent with Dominion Lending. And Brad and I go back way back in the RBC days when we used to sit kind of side by side. So I thought it would be great to have Brad again, but this time talk to us a bit more about what we need as a first-time home buyer in terms of what we could expect. So welcome back, Brad. So maybe again, for those who maybe didn't see last week, tell us a bit about yourself again.
Sure. So again, Brad Volkins. I'm actually a mortgage agent level 2 now, Pierre. Our lovely
two. What the heck is level 2, Brad? What does that mean?
So we put FSRA, which is our government that looks after the mortgage industry. They basically said that we had to now take an extra course to become a private lender. So in order to go out and find private lenders and lend private money out, it was a different level that we had to go with. So there's a level 1 that doesn't deal with privates, and then there's a level 2 that's all they can do is privates and so forth. Yep.
It's excellent, because if I go to the bank, right, and I don't fit into the bank's box, and I need different source of lending, maybe that are private, you could provide us with that, as opposed to just fitting into that nice box. So
and a lot of mortgage agents don't have that level 2, right? So you have to be very careful of who you deal with, right? Because level 2, the mortgage agent level 2 is the only individual that can deal with privates on top of everything else.
So maybe for our clients that are wondering, why would I go to a private mortgage as opposed to, for lack of a better word, a regular mortgage? When would that happen?
You know what? Sometimes it's very quick and easy things like today we're doing our taxes, right? So if you owe income tax to Revenue Canada, and it's just, you just need to get it cleared up. A lot of people go to privates just for that short-term financing needs.
Perfect.
Right. So,
perfect. Excellent. So again, I've heard you from last week where you just have a whole bunch of options. So this is just another option in your toolbox that may not be available elsewhere. Having said that, so a lot of our clients, I know Josh last week kind of touched upon, the international student market, whereby most international student and Canadians as a whole is to have that dream of home ownership, right? That first home. What if I'm thinking of buying my first home? Why should I come to you, and what will you have to offer?
It's a perfect question. So what we usually do is that with our first-time home buyers, we go through everything. We go through what their income looks like as of today, what that actually would qualify. We go through debts with them through the credit bureau to make sure the credit's in good shape. But we also talk about how do we get to that next level. So, we pull credit and we actually go through the debts. Okay, so, if you have all these credit cards, the first thing you want to do is pay these debts off. These credit cards need to become zero. That's the first thing. Next thing is then you need to save for a down payment. What's that down payment look like? Depending on what the purchase price is. Again, if you want to purchase for anything for $500,000 or less, you're looking at 5%. But as soon as you go to 600,000, well, it's 5% of the first 500, and then 10% anything above that, right? So we kind of go through those stages and say, okay, setting up a plan, pay off your debts. Next thing is, how much money do we need? Where's that money going to come from? How long is it going to take you to save there? Is there family that's going to help you gift those funds to you, right? And then once we get to that next stage, then we start going shopping around and see what else is out there.
Excellent. And I'm sure a lot of people weren't even aware, because they hear first-time home buyer, 5% down, so $800,000 home, 5% of 840,000, and then they get a big shock when they find out that they need to put a bit more, and then there goes the the dream of home ownership, right?
Yeah.
So it's a good thing that you kind of point that out. Now, what else should they think about in terms of down payment? Like, I guess, what kind of credit score are we looking at? If my credit is bad, is that it? Is that the end?
No, you know what? So normal banks want to see roughly around. So credit scores range from 300 to 900. 300 is basically being a bankrupt, right? 900 is being having a score of 900 is actually being perfect. Most banks want to see two trade lines. So a trade line is a line of credit, credit card, anything that revolves. So they want to see that somebody's had two trade lines for the minimum of 2 years, right? Can you get exceptions to a lot of these things? Of course. But a minimum credit score for any bank is going to be around 600 to 620, right? Anything below that, you're kind of putting yourself into a different category where you're going to require a lot more money down to get financing. And I think what a lot of people, and then what we're seeing a lot of people right now is, listen, a lot of young people want to live for today, right? They want to go enjoy themselves. What we always suggest to these people is, which is fine, but live within your means. Try to put stuff on credit cards. Like if you're going to go use your credit card for groceries and gas, great. Turn around the next day and pay it off, right? Because those are the types of funds you're always going to have in your pocket. It's money for gas and groceries, right? The other big thing that it's always frustrating is people love brand new vehicles, right? And now vehicles are, bare minimum. I seen one kid the other day that bought a brand new truck and it was $1,600 a month for the payments.
Wow.
Right? So $1,600 just for it's a mortgage payment, right? So you kind of have to pick your poison. If you want a brand new vehicle, well, you might be kicking the can down the road on that house, right? So I always tell people, listen, focus on the house first. Drive that little crap box of a vehicle until you get in there, and then you can always buy that vehicle later, right? So
exactly. Perfect. No, good. So credit is important. So 600 to 620. Of course, if it's
that's
better,
the bare minimum. Right?
kind of the bare minimum. Now, if I don't have that, so that means I can't go to the traditional lenders. Is there other lenders that that we could go to that their criteria is not as stringent as, let's say, you always hear about A lenders, B lenders. Maybe if you could elaborate a bit more on that.
Sure. So I always kind of classify them as sandboxes, right? We got to stay in a sandbox. So an A lender, like a big bank, Scotia, RBC, CIBC, they're an A lender, right? A B lender is an alternative lender that allows for bruised credits to happen. Really focus more on areas, marketability of the property, and so forth. So if you're going to buy something in the GTA area and you have bruised credit, so something your credit score is less than 600, you might have to put down 20 to 25% in order to purchase that property. And the rates are going to be a little higher. They're usually about 1% higher than what a traditional bank would charge. And then typically they charge fees, roughly around 1 to 1.5%, right? So you can still get into a property. You're going to have to come up with a lot more money down, and it's going to cost you a little bit more money to kind of maintain that mortgage, right? So the cost effective because of somebody that decides not to have a good credit and doesn't want to focus on the credit, it will cost them in the long run.
Okay. But it's something you could also work with that particular client. So I want to get in because I know the market is going to heat up, prices are going to go up. So I need to get my foot in the door. So I got my foot in the door, but working with Brad, whereby hopefully by next year or 2 years from now, I should be able to have better credit. And then what could you do at that point?
So we can always better credit. So with our clients, if we have to go that route to a B lender, we work with you and say, okay, here's the next steps to how to improve yourself, right? So we might put you in a 1-year term if we don't think your credit is that bad, or we might put you in a 3-year term if we think we need more time with you. But the job is we lay out the plan for you, what you need to do. We follow up with that plan to make sure that you're doing what we said you should do. And then once you accomplish those goals and your credit's back up, we will then just switch you upon maturity, switch you back to our normal bank.
Excellent. Perfect. Now, when should I get in contact with you? Should I wait until I find the house? and then put an offer and then call you at the last minute to
no. I'm the first step that you should always go to, right? So as soon as you think that, hey, I would like to think about maybe purchasing a house down the road, that's when you should get in touch with any type of mortgage broker. Let them go through your credit, let them go through your income, let them see your total financial picture. And then from there, if you're ready, great. If you're not, let them build a plan for you so that you can get ready. And then again, once you are ready, go ahead.
No. What about this? I always hear this thing called a pre-approval. What what is that in terms of getting ready to buy a house? So what's kind of the pre-approval?
Yeah, you know what? Pre-approval is really different to a lot of lenders. Most lenders don't underwrite what's called a pre-approval, right? So they don't look at income documents. They don't verify anything. They just say, okay, based on the information you tell me, you look pretty good, and we'll do a rate hold for 120 days. There is some lenders that if they have time, they'll review everything for you. But in most cases in today's markets, especially when things are starting to heat up, nobody has time just to kind of go through the documents, right? So you're really relying on a specialist like myself that actually knows what the banks are looking for. And that's where I'm saying, okay, you look good. This is where you need to tweak a little bit here and there. And then again, if we think we're ready, we'll hold that rate for 120 days until you actually find a property.
So that makes good sense. So really, the pre-approval from the way you kind of put it is one of the main reasons is to hold on to that rate for up to 4 months per se. And then I would imagine if the rate goes down, I'll get the better rate. But it's not necessarily a guarantee that I've been approved for the mortgage.
No, you got it. You're absolutely 100% right. A lot of lenders, again, won't look at any details of your employment or credit until the day that you actually buy something, right? So
would you say I'm armed with the pre-approval? Don't go firm on the deal until you get the actual approval.
Going firm is definitely a risk that you're going to take on your own. There shouldn't be any individual out there that would actually tell you 100% to go firm. Even if I think that you're solid,
maybe you could. Sorry to interrupt you. Maybe you could tell us what going firm mean, because I guess you and I we've been at it for so long that we kind of know what we're those terminologies. But for the layman, what does it mean to go firm when you purchase a house?
So let's go back to the COVID days when you were making an offer and you had to go what we call firm, which means you would put an offer on the table and you would have no conditions, no financing, no inspection, no appraisal, nothing that actually gives you a way to get out, right? So when you go firm, you're 100% committed to purchasing that property. And if you don't get approval or something does go wrong before closing, you will then obviously lose your deposit.
So you don't want to go firm until you know for sure that your mortgage has been approved, and then that way you know that you'll be able to purchase that home. Until then, I guess you want to have a condition, and maybe probably the two best conditions will be subject to mortgage approval and subject to an appraisal and inspection.
You got it. And again, I mean, you could have a person that with high earnings, low debts, like just a solid individual that goes firm on a property that may have issues to the bank. Remember, the bank wants to prove you, but they also want to prove the property as well. If they don't like the property, they're not going to lend on it. And you might think that it's not a big deal, and it's located near a gas station, or it's railway tracks beside it, or it's got a little bit of mold in the corner. Not a big deal. I'll just I'll get that fixed. The banks have an issue with the property. They won't finance it.
Excellent. No, all great stuff. I mean, I've learned also a great deal again today. Not to go firm, right? on a property. Learned about again the reasons to go to a mortgage broker such as yourself, or mortgage agent level 2, such as yourself, to give us a whole bunch more options. So maybe just in closing, again, how could we get in contact with you if and when I'm ready to take that big step?
Absolutely. So again, my email, brad@expertlending.ca, or call my office at 289-485-1010. Thank
you again for sticking with us for 2 weeks, Brad.
Yeah, you got it. Thank you.
Excellent. So this ends another episode of the Tomachek Financial Team weekly podcast. Don't forget to like us, subscribe, and get in contact with us with all our various social media. We hope that this was informative, and we'll see you again next week. Have a good time. Bye.